Good morning or good afternoon, everyone. Thank you for joining us today on this ASFMRA Farm Management webinar. My name is Lacey Miller, and I will be acting as your host today. So welcome. Thank you for joining us. Please feel free, if you haven't already, to put your name and your location into the chat so we know where you're joining from today. We're really excited for this webinar. There are a lot of people registered, and we're happy about that. So thank you for your support. Today we have with us Brad Haight. Brad is joining us to talk about the solar farm impacts on land value webinar. Our presenter, as I said, is Brad. He's an attorney and the founder of LeaseGen. Brad specializes in valuing and structuring wind and solar lease revenue streams for landowners and investors. With extensive experience in renewable energy, he helps clients analyze the impact of solar and wind projects on land value. If you have questions today, please drop them in the chat. I'll be monitoring the chat, and Brad's also leaving time at the end for Q&A. So please make sure to take note of those, and we'll get to them later. So with that, I will turn it over to Brad.
Yeah, thank you very much, Lacey. Uh, yeah, the focus will be solar. It's hard, however, to talk about solar without also talking about wind because there's some analogs in wind that we would apply to thinking about solar. And I think we probably ought to talk about batteries as well, BESS, battery energy storage systems. We'll avoid small nuclear, even though that's now becoming a hot topic as well. Lacey mentioned a little bit about me. I'm going to give you a little more information just so you can have understanding of my actual scope. I've wearing three hats, and I've got partners, different ventures that will help me, with those specific ventures. But I am still an early stage project developer. I have different partners, different projects across the country. Right now, we're mostly pursuing projects, community solar scale projects in Illinois. I think we've got 4 or 5. And we've got some wind projects in Colorado, solar projects in New Mexico. And our focus there is, identifying early stage opportunities, and then we sell them up. Frankly, we sell them to the best suited partner. LeaseGen is a passion for me. It's the least lucrative of all the things I do, but I truly care a lot about it because it matters a lot. LeaseGen is all about it's about valuing revenue streams, and I've been doing this since 2014. And I do it because I think there's a lack of understanding about the different issues, different project features, different market features that affect the value of the revenue coming off these projects. And then to fund my habits, Farm First and LeaseGen, I still practice law, and my goal is to bill less than 80 hours a month. It seems like I'm always doing a little bit more than that, but I do practice law, and the work that I do is almost entirely real estate focused. I work for high net worth individuals. I work for funds. I work for institutional investors, helping them do wind, solar, battery across the country. I work for big farms and ranches, mostly in the West, helping them do the same. And then there are 3 or 4 owner operators that I will help as well on sort of more complicated real estate transactions. I've been doing all of this for quite a long time. Sort of stumbled into wind actually from oil and gas. I was doing oil and gas in the late 90s when one of those clients himself found himself in the wind business, and that was my entree. I thought it was interesting and have been doing it ever since. I am one of about, I'd say, 7 or 8 guys, and I'll give you the names of the other guys at the end. One of about 7 or 8 guys that I think do quite a lot. I mean, I probably 2 or 3,000 different sort of wind, solar lease transactions at this point. There's pretty much a new one every day. Well, not every day, through two a week, right? That we end up working on. Uh, Lastly, I've got a slightly different perspective than a lot of lawyers. Part of the reason is because I was in-house. I worked as a developer for a bit. Actually built a wind project in Montana and developed a couple of others. One in New Mexico, one in Colorado that were also built. Uh, if you guys need information from me, uh, you are certainly and absolutely always welcome to call. I've never sent anybody a bill just for calling. I won't. Uh, Please do feel free to call. I'll share what I know when and where I can, and I'll always disclose the relationships that I have that could present conflicts for you, potential conflicts for you. Going back, reorienting a little bit. Talk about solar. That's our goal today. Uh, it'll be two varieties of solar. It'll be utility scale solar. It'll be community solar, and we'll talk a little bit about batteries as well. Uh, Solar itself, it's solar panels in fields. It's about 6 to 8 acres, I would say, per installed megawatt. In the power sector, we talked about projects capacity in terms of megawatts. Uh, Again, 6 to 8 acres. Sometimes we see more, sometimes a little less, but about that number of acres per megawatt of generation capacity. Um, in the case of utility scale solar, we just seem to be getting bigger and bigger and bigger. I'm on some deals that are 10,000 acres. I'm on some deals that are in construction now that are 2,000 to 3,000 acres. That's the utility scale variety of solar. The community solar uh, is generally 5 megawatts, well, 2 to 10 megawatts, so 10 to 50, 60 acres maybe. Uh, Obviously, always a bit smaller, and all sort of policy driven, program driven, typically by state mandates. Batteries, the size is all over the map. And I think it's going to remain sort of all over the map for a while. Um, Batteries are interesting at the moment. When the administration changed, the big beautiful bill was passed. The tax credits around solar and wind were significantly changed. Um, uh, Not to the point where they'll never go again. I mean, we're still seeing wind projects being developed. We're still seeing solar being developed. The tax credits around batteries, however, weren't touched. And so the battery market has remained strong. We're on a couple of battery deals, some that we've helped develop. The one that I can probably speak about, will anyway. That's 80 acres. Surprisingly big, surprising number of acres. 250 megawatts of capacity. It's containers is what it is on land, but it doesn't need to be that big. Everybody seems to do it a little bit differently. I've been told that you can do the same size on 25, 30 acres. I think you'll see. I think you'll see batteries as well on smaller lines. Typically, right now we're seeing them at substations on great big lines. That's where the money is, right? You want to build to scale. To build to scale, you need to be on bigger lines, and then being on a substation is ideal because it reduces the cost of getting onto the grid. That's true for utility scale solar and for batteries. But right now, we're in historic times vis-a-vis uh, electric power supply, electric cars, air conditioners, manufacturing. Those are all growing at rates that are a little higher than usual. You've also got now layered on top of that, AI, and AI. is part of what's causing electricity growth now to be sort of 5 to 10x what it typically is. And that means we need more power on the grid. Well, unfortunately, nuclear is going to take way too long. Coal is going to take way too long. Gas would be awesome if we could get gas onto the grid, but there are no gas turbines available, at least not generally. So what do? Well, you build batteries, right? Because you can use a battery to store power uh, during or store power, excuse me, for dispatch during peak situations, and that's why I think we'll see a rush of battery development over the next sort of 5 6 years. That plus the fact that the tax credits weren't affected. Um, Mostly, again, I think these guys are going to be targeting substations, and those historically have been big substations. I think, however, you'll start to see batteries targeting small substations, distribution co-op substations as well. And I think you may also end up seeing what are called line taps. That is, the project will build its own substation on a line that is strategically significant to them. The guys doing this matter, and they matter to the value proposition as well. Uh, you've got really sort of four categories of developers, maybe three real categories of developers. You've got the independent power producers. These are the Invenergies and NextEras of the world. Those guys have awesome track records. They get things done. You still have what are called a handful of pure play developers. These are the companies that are developing assets, development assets for sale, and they're typically selling to the NextEras and Invenergies of the world. Since the big beautiful bill, a number of those have disappeared, especially the foreign backed ones. They seem to be gone. Uh, uh, Orion is one that sort of sticks out in my mind is still being around, and they are self-funded. I think they're a strong company. I don't think you can go wrong there. Nor do I think you can go wrong with sort of the NextEras and Invenergies of the world. And the utilities are in this game too. Utilities, they need the power for one, and generally speaking, they can make quite a lot of money if they develop and own these assets. There's an interesting podcast about Xcel Energy, my utility, our utility, primary utility in Colorado, and how much money they're making rate basing these assets, solar and battery projects, and then we've got another category of developer, making the air quotes symbol for these guys. I'll call them the charlatans. Uh, as and when sort of the industry starts to take off after having suffered a negative impact like the big beautiful bill, the charlatans tend to come out of the woodwork. Every time tax credits were renewed in the past, the charlatans came out of the woodwork. These are two guys in a truck. Sometimes there are several guys in a van signing up land, looking to flip it to the IPPs or the utilities. They are still around, although I will say we see far far less of them than we used to see. All right, so that's landscape. Now I can sort of transition into the money, and I'll speak generally about the money first, and then I'll start to get into the value piece. Oh gosh, I'm trying to remember the first year I saw a solar lease. I actually don't remember the first year that I saw one. I do remember what I thought, which was, wow, this is interesting. I wonder how they came up with these values. The values being sort of the rates that they were going to be paying for the leased land in the West, where I am, also Texas. What we saw was lower value land. The rates for the solar tended to be in the 25 to 40% of land value. So $1,000 an acre, they're paying, or we're paying $25 to $400 per acre per year, escalating at a fixed rate 1.5 to 3% annually. In the Midwest, on the higher value land, using Illinois sort of as an example, rates tended to look like an amount that was 2 to 4 times cash rent. So if the land was renting for, $300, uh, uh, the solar rate would be sort of $900 an acre a year. Again, also escalating at a fixed rate. For the community projects, the rates were always quite a bit higher. Again, these are sort of the 2 megawatt, 10 acre to 10 megawatt, 50 to 60 acres projects. Those would be 50%, 100% higher than the typical utility scale rates. Um, Generally in the West, with these types of rates, we didn't see problems even as the rates have gone up, or especially as the rates have gone up, we haven't seen problems with those. In the case of higher value land, good farmland in the Midwest, this doesn't necessarily work, and we'll get into some of that in just a second. Uh, Generally, sort of moving into the value piece itself. Generally, I am of the mind that if there's no steel in the ground, there is no value. So if you've hypothetically got a solar lease on your desk right now and you're trying to figure out what the value is, if that project has not been built, I would say that lease has no value. And I say this noting principally sort of the position that the institutional folks that I work with take, and the position they take is just that: no steel, no value. If it's not in the ground, we're not going to assign any value to it. I have one instance where that was not the case, and that was a project that was actually in construction, and we had the highest degree of confidence that the construction was going to continue, and that the project was going to be built and commissioned. So that's one case out of 1,000, right? Where absence of steel in the ground did lead to some value. Not only do the money guys see no value if this isn't built, I would note that even the perfect project can fail. I was hired to evaluate a solar lease 2 years ago for a project that had not yet been built, but it was truly the perfect project. It was on a brand new, very large substation. The developer was as sturdy as they come, had cheap capital. There was a massive solicitation coming for power. The stars were lined up, right? This thing was perfect in terms of being built, and I reiterated my my position, in sum, no steel, no value, but with a lot more detail around sort of all that can go wrong, and not positively for the landowner, positively, I guess, for my track record, I was right, notwithstanding the fact that everything was right about that project. It wasn't awarded and it wasn't built. So in sum, on that one piece, I would say, again, if you've got this lease, if there's no infrastructure yet built, I wouldn't assign any value. Now let's move to the other scenario where something is actually built on the ground. Now you're in the world of calculating net present value. Generally speaking, I would say that it's a pretty safe bet. It's not perfect, right? Things can happen, but I would say by and large, start with some would say 6% discount, some would say 7 or 8% discount, and then work from there in terms of how you adjust that based on different project features, different issues, and how you adjust it over time. At the macro level, right, at the highest level, what you're thinking about, I believe, is the risk of decommissioning, right? That's the risk to the revenue stream. Is this project going to hold up? Unfortunately, we don't have we don't have a lot of information about the decommissioning risk around solar projects. Uh, we do, however, have analogical information, if I'm using that word right, with respect to wind. And so when I'm thinking about sort of this big picture risk, the decommissioning risk, the risk that the project falls apart, I'm starting with a comparison to wind. One thing we know about wind is that the great majority of all projects have continued to operate. Even after they've reached the end of their useful life, they've been repowered and they continue to go. Uh, there was some data published by the American Wind Energy Association back in 2014, and this is the basis for a lot of my thinking about this. Uh, uh, that data was, all of the U.S. wind projects that had been built and their status, right? And then included within that data were project sizes, project owners, project equipment. One of the things that I was able to glean from that data, 12 years ago now, was that in the case of wind, the big projects continued, right? So if it was 50 megawatts, 100 megawatts bigger, those projects tended not to be decommissioned. The second thing I gleaned was that the best owner operators projects continued. So, if I'm thinking about value and I'm thinking about the decommissioning risk, I'm looking to see who owns and operates. If it's NextEra, right, that's a solid bet. If it's Invenergy, it's a solid bet. If it's RWE, it's a solid bet. In the case of NextEra, just by example, I know of exactly 2 wind projects that they've owned that have been decommissioned. Which is a really, really small number. And there are 2 features of those projects that also, I think, are noteworthy relative to that 2014 AWEA data that I mentioned, and that is that they were smaller projects. They were smaller, and they also had turbines, equipment that was no longer being manufactured. And these are some of the things that I think need to be thought about, that you guys need to be thinking about as you're looking at these solar projects too. As I was preparing slides this morning, I was asking myself, man, am I using the word qualitative correctly as I think about, sort of this analysis? And so I asked ChatGPT, am I using this word correctly? ChatGPT told me that for purposes of evaluating solar lease revenue, it's a quantitative analysis. And I actually think ChatGPT was wrong here when it comes to these risk issues. I think it is a quality thing. I think that, the analogical information from wind tells us that as we're evaluating these deals, we need to be looking at the quality of the owner operator, right? Because we know from wind that, the less sturdy owner operators projects fail much more so than did sort of the NextEra than FP&L projects. We also know that quality of equipment mattered. The NEG Micon, the bonus, right? If those were the turbines that were deployed in the case of these wind projects that were decommissioned, well, it would seem to be the case that if you've got weaker equipment in the case of solar, you've got lower quality equipment in the case of solar, decommissioning risk ought to be higher. Now, that said, there are some points, I think, relative to solar that are markedly different from wind, and that is, the equipment doesn't have moving parts, generally speaking. The tracking system may have some moving parts, maybe some moving parts in inverters, but everything's inert in the panels. So everything is largely commoditized. And I would say that while the qualitative features matter, not so much relative to the equipment itself, at least not relative to wind. Other things, though, I think are terribly important in terms of this sort of broader analysis. And that is, market. And within market, I would say it's also sort of the program, right? That's sort of driving the development, driving the generation, and it's utility resource planning. Uh, Lacey and I are in Colorado. Colorado is effectively a transmission island. We've got a market essentially for these projects of one, right? If the project is interconnected on the Xcel Energy grid, for all intents and purposes, that's the only market we have for that project. In my opinion, the fact of that sort of market of one would result in an increase in the discount applicable to that project. Maybe not initially, but further down the road, if you're looking sort of past the project's useful life, past the project's power sale agreement, yeah, that project has more risk than would say, for instance, a project within the ERCOT Texas grid. That's a liquid market. PJM's a liquid market. MISO is a liquid market. In those markets, in contrast to sort of what we've got in Colorado, if when the project reaches the end of its power sale agreement, there's a chance to sell the power to somebody else, and that means the project life potential is better at that point in time than it would be sort of here in Colorado. Uh, and further to this point, right? If you want to get into the weeds a little bit, if you can get into the weeds a little bit, the utility resource plans are a good indication as well of sort of the viability of the project. Utilities have to file these plans with their regulators, and you'll often find detail there that will indicate sort of their long-term plans with respect to assets for which they're purchasing power, but also with respect to assets that are in their own portfolio. And I think that's especially important now as utilities tend to own more of these than they did in the past. And if I may, I would say that if I'm comparing sort of a project owned by Mid-American, right, versus a project owned by Apex Energy, I would say that the Mid-American owned project is probably a safer bet, right? Because Mid-Am is itself a utility. They don't necessarily have to renew their contract with the Apex, but they are, I would say, more likely to continue the projects that they themselves own. Boy, and now I'm struggling with my segue here. This is one of the few sort of real world examples of a solar project evaluation. And this is public information. This was a farm that was for sale in Illinois. There was a community solar project on that farm, and the seller was publishing the lease rate, the escalator, and the sale price, right? The value sort of the balance of the farm. When this was public, some of the guys that I worked for, called me up and said, "Hey, let's do a valuation on this. Let's see if this is something that we want to buy." And we did, right? We took a look, and it was probably one of the most unflattering of views that we saw on any asset that they were looking at that had renewable generation equipment on it at the time. And the reason was because the solar lease rate discounted, right, was about the same as the value of the land itself. Right. So if you look up at what would be year one, right, the net present value of the solar at $1,250 an acre was worth, $190K. The land value itself was also right at $190K. I go to year two, presuming, escalation in the fee value of the land at 6%. Maybe that's a little bit high, right? But when I get to that point, certainly when I get to years 6, 7, 8, 9, 10, we're essentially underwater with the solar, right? So I've got a I've got a solar lease, the NPV of which is 200 200K, something like this, but I've got land that's worth an awful lot more, right? And so now we've got something that's unattractive. Well, what we decided to do was figure out how and in what situations, what circumstances, something like this would work. Um, because there is a bit more to it, meaning that yeah, we've got two assets that are easy to value, solar lease NPV, land value, but there is a cash rent component too. And arguably there would be value in the difference, right, between the annual solar payment and that cash rent payment. And maybe we can take that additional money and we can invest it and presume some sort of return on it, right? When we pulled all these factors together, what we realized was what we wanted to see was, I don't know if you guys can see my cursor. No, you can't. What we wanted to see was a much bigger number in that bottom left green cell, the one that says 89.25% on your screen. What that number is value of the solar over time relative to land value plus land value escalating plus the delta between cash rent, right? No, sorry, it's the solar value plus solar NPV plus delta between solar value and cash rent invested over time, if that makes sense. And I'm there's a lot here. I get it. If you guys want to talk to me separately about it, please call, and I'm also happy to share this spreadsheet with you, or this worksheet with you, so you can see it. But we wanted to make this 300%, right? And we were able to do that, right? But the only way that we were able to do it was by taking the solar lease rate quite a bit higher. We had to take it up to $3,420 an acre a year in order to make the numbers work for sort of typical investment. And I think this matters, right? I think it makes sense. I think you're looking for sort of that 300% piece, because then the buyer, the investor, is able to get comfortable, right, with the prospect of being underwater. Frankly, I'm not going to take absolute full credit for this. I am going to take quite a bit of credit. But other guys certainly helped me. Other investors helped me. Dave Muth at People's Company helped me. Jake Costanzo at People's Company helped me sort of think through all this. And they've got this information as well if it's something that you guys want to see. I'll try to go another 5 minutes or so, and then we can take some questions. Best money. The only thing I can say about battery money is that it's goofy. If you're seeing any of these deals right now, I'm on deals that are in construction, land value of $1,500, $1,700 an acre. Those are paying $6,000 to $7,000 an acre a year, escalating. I know I've got 2,500 written down here. I think that's probably about the average, but some of these deals are on land that's worth even quite a bit less than that. Purchases on some of this land. Here we're looking at purchase prices being executed, or purchase agreements being executed with legit players. In the West, $70,000 an acre. I haven't seen these deals in the Midwest, but I have heard of purchase options for $250,000 an acre on good farmland, but not farmland that's certainly not near that value. Couple of more pieces just on solar. uh, things that I watch for, and things that you should watch for if you're doing valuations. I would watch for the minimum. Um, every one of these contracts, be it wind or solar, uh, they generally authorize the project owner to terminate land in part at any time and in their discretion. As the solar equipment itself um, becomes better, right? The capacity of panels increases. You need fewer of them, and so uh, I think when the first wave of solar projects is repowered, you should expect that uh, your 1,000 acre project will be 800, 750, something along those lines. Um, and I think that's certainly worth noting. I don't know what the timing is going to be on these repowers because we frankly haven't seen any yet. But if the lease itself doesn't have a minimum acreage obligation, I think you're making an adjustment based on that feature. And then I would watch out for sort of the farmability issue. Uh, just noting that it tends to be disregarded. It maybe doesn't necessarily fit so well in this sort of valuation discussion. However, it's a philosophical thing for me. Personally, my belief is that um, we shouldn't be doing these things. We shouldn't be doing these deals, these wind deals, these battery deals, these solar deals, if they don't work for the farm, right? And so I'm always sensitive to looking to see that, especially in the case of solar, we've got something that addresses sort of how islanded land is treated if that actually becomes the case. Because of sort of the discretion given to the company in terms of equipment location. Um, think I'm doing pretty well in terms of timing. I'm right at about 40 minutes. Uh, I think lawyers are actually a good resource for you guys. If you need help, I mean, I'm certainly happy to take calls. I don't know and see everything. Uh, what you see on the screen now, these are the guys that I go to if I've got questions. They do work for landowners. Jake and Rod Wetzel and Sweetwater have done more than anybody in the country. Cole and Cody and Canyon, they're seeing quite a bit more. They're involved in some extremely cool deals. Kathy in Des Moines, uh, she's probably done as much as Jake, quite a bit for the companies as well. We'll have seen a lot. Super conscientious, great lawyer. Same with Tom and Jonathan Stoller. Illinois is seeing an awful lot of development, wind, solar, and battery, and so these guys will see a lot, and they'll be a potentially great resource. And then Steve in Wisconsin. Steve's just frankly awesome, right? I mean, he's always been willing to sit down with me and think through issues. Reason for him making this list as well. So that's the extent of what I got. Happy to field questions for you all.
Thank you, Brad. If you want, you can stop your share, and if people have questions, please feel free to come off your camera and unmute so we can see you and answer your questions. I know, Lenka, you had a question in the chat. If you want to unmute, please feel free. Otherwise, I can ask it for you. So the question we have in the chat is, how difficult is it to obtain permits for these projects?
Oh man, depends. I mean, the typical lawyer answer, right? It depends.
Mm-hmm.
In eastern Colorado, other than Washington County, it's easy. Washington County doesn't want to permit projects. That's historically been their position, and it is generally a county level issue. Uh, we hear about permitting struggles in a lot of rural areas right now. There's an opposition. There's an opposition to wind, an opposition to solar. Um, I would say there's not much opposition in Texas. I think Texans generally sort of respect this idea of if it's your land, you should get to do what you want with it. I think Eastern Colorado is similar. I would say the same in New Mexico. Um, in uh, in Nebraska, I mean, I'm working on some things now in Nebraska, and a lot of local opposition, right? And the counties get to decide. And my personal belief is the counties ought to be able to decide, right? They get to enforce the police power. Now, all that said, go to Illinois, and Illinois, in its infinite wisdom, decided that the locals didn't have the requisite sophistication to permit projects, and so they said, here are the permit rules, and thou shalt not deviate from these. So in Illinois, everything gets permitted so long as you follow the sort of the state level requirements.
Thank you.
So
So what's usually the sequence? Do you apply to the county first, or do you secure a lease first, or how does it work?
uh, leases first. Yeah, leases first. And I would say all the leases first.
Okay.
All the
Thank
leases, all the easements, if you need neighbor agreements as well, and then go to the county. Yeah.
So this basically drives your point that, unless something is already built, the lease really is worthless because you may never get it permitted.
I think that's right. Yeah. But like, look, if you're in, I can't remember the county in Nebraska, right? There's a moratorium, right? I mean, if somebody's got a lease, if there's a moratorium, there's absolutely no value. In fact, I would say, I would probably say the fact of the lease maybe even hampers the value of the land, right? Because you now have an encumbrance. You've got an encumbrance that limits what you could do, but there's nothing sort of at the end of the tunnel.
Would you happen to have any pictures of what these things look like? I'm having
Uh,
a difficult time figuring out how the land would be farmed with these projects on it.
with solar,
Yeah.
you're not farming it.
Oh, okay. Okay.
Yeah, I mean, I'm sorry. Yeah, you're just okay.
I misunderstood. Thank you.
Yeah,
That's fine.
no, no, I I shouldn't speak categorically. Um, but as a general rule, no, it's not going to be farmed, right?
Okay.
But to their credit, right, there are some community solar companies that are going out of their way to add ag components to their projects. So I did used to do work for Pivot Energy. I have friends at Pivot Energy. I think these guys are great. They do community scale, distributed generation scale solar projects. They've got about 200 of them. Every single one of them has bees, flowers, chickens, goats, pigs, even sometimes some, not row crops, but crops that are being picked, and they're now trying to figure out how to, add row crops in between the rows of their solar. Uh, I don't know if that ultimately works, but uh, I commend them for trying for sure. So let me see if I can send you. I mean, look, this is what it's gonna. You asked for a picture. This is what it's gonna look like, right, before the panels go on. There's no room for a sprayer in there. No room for a combine in there.
Right.
Yeah, I actually had a really interesting discussion with a guy from one of the utilities 2 years ago, and I said, no, you guys have been studying, this agrivoltaics idea. That is, how do you farm inside solar projects? I said, what works? And he said, cucumbers. The only thing that we can figure out that works is cucumbers. So that's as of a few years ago. Maybe there are other things that work now. But ag underneath these things tends to not work. And that's why, a lot of owners, right? And I commend them. A lot of owners on really high value farmland, they just won't do it, right? Because the ag component is too important.
Thank you.
Yes, ma'am.
Don, do you want to unmute?
Hi, Brad. This is John Nicholas. I'm just curious if you studied any relationship between the discount rate for solar as compared to alternative investment yields for such as bonds, junk bonds, anything like that.
Uh, I'm John. I'm not that sophisticated. What I do is I go to a handful of sort of farm managers and investor owners and ask them, what's the market, right? And that's my starting point. And then we adjust from there based on project features, market features, et cetera.
Okay. So that's where you're pulling the 6 to 8% from.
Yeah. So there's an ag economist at the University of Illinois named Bruce Sherrick, right? And I'll try to talk to Bruce once a year. Bruce, what are you seeing? And I remember the very first time I talked to him, it was about wind. I said, Bruce, what do you see? And he goes, well, we see anywhere from sort of 8 to 15, all over the map,
Mm,
right?
okay.
I don't think it's quite that way anymore, right? I don't think there's as much sort of distance between the high and the low, but it's still variable, right? And sometimes the market, the buyers, they just don't want to deal with this stuff, right? Right. At certain levels. I mean, I've seen zero value assigned to projects before, not solar, mind you, but zero value assigned to wind. And
Mm,
it's not the norm, but it has happened.
well, okay.
Yeah.
Okay. All right, great. Thank you.
Yeah, you're welcome.
And next we have a question from Rachel.
Oh man, did Rachel ask that hard question about soils?
She sure did. What are
Yeah,
the impacts of this to the soil pH, soil structure, etc., for projects after 20 years?
yeah. I don't know. Now, in my defense, I've tried to figure it out, but I'm not smart enough to figure it out. I will say, and this information is fresh because I talked with the Pivot guys about it Saturday night. They've been collaborating with Colorado State University on their sites, and they're collaborating for the purpose of determining what does happen to soil health, right? Given the fact of these projects. I've also talked with Tom Jennings about it. So Tom was one of the Illinois lawyers that I mentioned. Part of the reason that Tom is so awesome and such a great resource is that he's also a master's degree level soil scientist. So he was an ag kid, right? And he gets soils. Uh, he's been, I think, generally watching what's going on in Illinois, maybe at, I don't remember which of the universities, but I think one of the universities in Illinois was also looking at it. I think Iowa State's been looking at it too. I read an Italian translated Italian study, right, once that seemed to yield no information. Look, it's worth paying attention to for sure, right? But sorry, Rachel, I don't know the answers.
Are there any other questions today for Brad? Oh, yes, here's one. How many years are these typically uh, leased? How many years are these leases typically once the solar panels are installed?
40 to 60. And the solar panels will have a 20-year plus warranty. They should last, right, 20 years. The inverters are sort of 10-year warranties.
Mm.
Uh, uh, yeah. These projects, if wind is any indication, they should go for the full term.
Okay, we have a follow-up to the soil question. So with the unknown soil impacts, is there financial consideration to the potential impacts given to the property owner?
So far we have not. No, we've not. Now, there may be some sort of carbon deal that can be done there, right? Some sort of sequestration deal that can be done, but uh, the sequestration guys, like the Indigo guys, Land O'Lakes guys, they seem to want quite a lot of land, and the solar groups that I've worked with, or the owners with solar that I've worked with, haven't had quite enough land to try to monetize that.
Okay. Any other questions?
I feel like I'm in an auction.
I know. I'm trying to practice wait time.
Yeah.
So thank you everyone for your attendance today. Thank you, Brad, for your time and sharing your expertise with us. It was really wonderful to learn more about this subject. And I want to remind everyone that there will be another management webinar on Monday, March 16th. If you want to hear about trade and tariff policy impacts, please go to the ASFMRA education page and register for that. We look forward to seeing you there and at other educational offerings in the future. Thank you so much and have a wonderful afternoon.
Thank you.
Thank
Thanks,
you.
guys.